Then came the land bubble. Public land was sold cheaply to accelerate settlement, expand the republic, and finance federal expenditures, often for as little as $2 an acre. However, there was a structural flaw at the core of this financial strategy. Payment for these lands was accepted by the federal government in depreciated state banknotes. During the War of 1812, state banks had been allowed to issue currency far beyond their reserves to finance government needs, and after the war, the practice continued quietly. Public lands were purchased with depreciated state banknotes, which the federal government knowingly accepted at face value. Officials believed this approach would support land prices, encourage investment, and accelerate settlement, even at the cost of stricter financial discipline. This is where small structural financial flaws compounded into larger ones. Land purchased with depreciated notes was assigned values well beyond its underlying economic reality. Depreciated banknotes, accepted in land purchases, inflated land values. Those inflated values were then used as collateral to issue more notes, which financed further land purchases and additional note issuance, creating a self-reinforcing credit loop and a massive land bubble. Federal land debt exploded from $3 million in 1815 to $17 million by 1818. The Second Bank of the United States had been created to restrain state banks and contain inflation. Instead, it joined the frenzy, mirroring state bank behavior rather than disciplining it. Its western branches, in particular, issued credit with little restraint. Exuberance was high, and the Second Bank was issuing loans wherever it could, not only into the land boom, but across the wider economy. Under President William Jones, the bank engaged in reckless lending and widespread mismanagement. Massive unsecured loans were extended to political allies and speculators in clear violation of its charter. Lending caps were exceeded, real estate holdings were carried far beyond their legal limits, undermining restrictions intended to prevent excessive foreign control of U.S. territory, and public funds were fraudulently diverted into private ventures. At the branch level, corruption deepened the imbalance. Offices in places like Baltimore and Natchez funneled credit to insiders through bribery and embezzlement, while paper notes were issued far in excess of available specie. Credit expansion accelerated, inflation spread, and both land and commodity markets were pushed further out of balance.